Look, I need you to pay very close attention to what I'm about to share with you, because what's happening right now in the gold and silver markets is something most people won't see coming until it's too late. And I'm not talking about some distant future scenario. I'm talking about movements that are happening right now, today, that could fundamentally alter the value of every ounce you own. Let me start with something that should make your ears perk up. In the last 6 months, central banks around the world have purchased over 800 metric tons of gold. That's not a typo. 800 tons. To put that in perspective, that's more gold than most countries hold in their entire reserves. And here's the kicker. They're doing it quietly. No press releases, no fanfare, just steady, relentless accumulation. Why? What do they know that the average investor doesn't? I'll tell you what they know. They understand that we're living through the final chapter of a monetary experiment that began in 1971, and they're positioning themselves for what comes next. But before we get there, let me take you back to a moment in history that most people have forgotten, but that's about to repeat itself in a way that could make 2011's gold spike look like a warm-up act. It's August 1971. President Nixon is about to go on television and make an announcement that will change the world forever. He's closing the gold window. No longer will foreign governments be able to exchange their dollars for gold at $35 an ounce. The Bretton Woods system, which had governed international monetary relations since World War II, is dead. And in that moment, the dollar becomes what we call a fiat currency, backed by nothing but faith in the U.S. government. Now, here's what's fascinating. In the months leading up to that announcement, something strange was happening. France, under Charles de Gaulle, had been converting dollars to gold at an alarming rate. They saw the writing on the wall. They understood that the U.S. was printing more dollars than it had gold to back them. And they acted. By the time Nixon closed the window, France had accumulated massive gold reserves, while other countries were left holding paper. Fast forward to today, and we're seeing the exact same pattern, but on a scale that would make de Gaulle's strategy look quaint. China, Russia, India, Turkey, Poland, they're all loading up on gold like there's no tomorrow. But this time, it's not just about protecting against dollar devaluation. It's about something much bigger. It's about the creation of an entirely new monetary system. Let me show you what I mean. In 2023, the BRICS nations, that's Brazil, Russia, India, China, and South Africa, announced they were exploring the creation of a new currency. Not just for trade between themselves, but potentially as an alternative to the dollar for international settlements. Now, you might be thinking, yeah, I've heard this before. It'll never happen. But here's what changed. They're not talking about backing this currency with faith or promises. They're talking about backing it with gold. Think about what that means for a second. If even a portion of international trade starts settling in a gold-backed currency, what happens to demand for dollars? What happens to all those trillions of dollars sitting in foreign reserves around the world? They come home. And when they come home, they buy things. That's inflation on a scale we haven't seen since the Weimar Republic. But here's where it gets really interesting for you as a gold and silver owner. The current price of gold, hovering around $2,000 to $2,100 an ounce, is based on a market structure that's fundamentally broken. Let me explain what I mean by that. The COMEX, the Commodities Exchange in New York, is where gold futures are traded. Every day, billions of dollars worth of gold contracts change hands. But here's the dirty little secret. Most of that gold doesn't exist. It's paper gold. Contracts that represent gold, but that will never be delivered as physical metal. The ratio of paper gold to physical gold is estimated to be somewhere between 100 to 1 and 250 to 1. That means for every ounce of actual physical gold that exists in COMEX warehouses, there are 100 to 250 claims on that same ounce. Now, as long as everyone's happy trading paper, the system works. But what happens when people start asking for delivery? What happens when the music stops and everyone rushes for the exits at the same time? We're starting to see the early tremors of exactly that scenario. In March of 2023, something unprecedented happened. The Shanghai Gold Exchange, which deals primarily in physical gold, not paper contracts, saw its price decouple from the COMEX price. For a brief period, physical gold in Shanghai was trading at a significant premium to paper gold in New York. That's not supposed to happen. In an efficient market, arbitrage should keep those prices aligned. But it didn't. Why? because there wasn't enough physical gold available to exploit the arbitrage opportunity. Let me tell you a story that illustrates just how tight the physical market is getting. There's a bullion dealer I know, been in the business for 30 years. Last year, he got a call from a client wanting to buy 500 ounces of gold. Not an unusual order for his business. He called his suppliers, the big refineries in Switzerland and the US. Normally, he could have that order filled in a week, maybe 2. This time, 6 weeks. And that was for a relatively small order. He told me that if someone walked in wanting 5,000 ounces, he honestly didn't know if he could source it at any price. This is the reality of the physical gold market right now. While the paper price suggests there's plenty of gold to go around, the physical market is telling a very different story. And silver? Silver's even tighter. Here's something most people don't realize about silver. While gold is primarily a monetary metal, silver is an industrial metal. It's used in solar panels, electronics, electric vehicles, medical equipment, you name it. And unlike gold, which is mostly recycled, silver is consumed. Once it's used in a solar panel or a circuit board, it's gone. The economics of recovering it don't make sense. Now, here's where the math gets scary. Global silver production is around 800 million ounces per year. Industrial demand alone is approaching 600 million ounces. Investment demand, jewelry, silverware, that's another 300 million ounces. You see the problem? We're consuming more silver than we're producing, and we have been for years. The deficit is being made up by above-ground stockpiles, but those stockpiles are dwindling. The US used to have a strategic silver reserve of billions of ounces. It's gone. Sold off years ago. The COMEX warehouses, which are supposed to back all those silver futures contracts, hold around 300 million ounces. That sounds like a lot until you realize that's less than 4 months of global demand. And remember, most of that silver has multiple claims on it, just like gold. So what happens when industrial users, who actually need physical silver for production, start competing with investors who want it as a monetary hedge? The price has to go up. It's simple supply and demand. But the current price of silver, around $24 to $25 an ounce, doesn't reflect this reality. Why not? Because the paper market is still setting the price, and the paper market is disconnected from physical reality. Let me give you a specific example of how this plays out. In 2020, during the pandemic, there was a brief moment when silver premiums, the amount dealers charge over the spot price, exploded. You could see silver quoted at $18 an ounce on the COMEX, but try to buy a physical ounce and you'd pay $25 or $30. The paper price said one thing, but the physical market said something completely different. That was a warning shot. A glimpse of what happens when paper and physical diverge. Now, I want to shift gears for just a moment. Because if you're sitting on a significant amount of retirement savings, $100,000 or more in traditional accounts, there's something you should know about. I've put together a comprehensive guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering tax penalties, and what the process actually looks like. It's completely free, and you'll find the link in the description below. If protecting your retirement savings with physical metals is something you've been thinking about, it's worth a look. All right, back to what's happening in the markets right now, because this is where things get really critical for anyone holding gold or silver. There's a concept in markets called price discovery. It's the process by which markets determine the true value of an asset based on supply and demand. For decades, price discovery in gold and silver has happened on the paper markets, the futures exchanges. But that's changing. We're starting to see price discovery shift to the physical markets. And when that transition completes, the price reset is going to be violent. Let me walk you through the mechanics of how this happens. Right now, if you're a large institution and you want exposure to gold, you buy futures contracts or shares in a gold ETF. You don't take delivery of physical metal because it's expensive to store and insure. But what happens when trust in the financial system starts to erode? What happens when institutions start to question whether those paper claims are really backed by metal? They start asking for delivery. And when they do, the whole house of cards comes tumbling down. Because there isn't enough physical gold to satisfy even a fraction of the paper claims. The COMEX has a mechanism for this. It's called cash settlement. If they can't deliver the physical metal, they can settle the contract in cash at the current paper price. But here's the problem. If you're asking for physical because you don't trust the paper, why would you accept cash settlement at the paper price? You wouldn't. You'd demand a premium. And that premium is where the real price of gold reveals itself. We saw a preview of this in March 2020. During the COVID panic, the gold futures market nearly broke. The spread between the futures price and the physical price blew out to over $100 an ounce. Traders who were short gold futures and needed to deliver physical metal were scrambling. Some of them chartered private jets to fly gold bars from London to New York because commercial flights were grounded. Think about that. They were paying thousands of dollars to transport gold bars because the alternative, failing to deliver, was even more expensive. That was a stress test, and the system barely held together. But the stresses we're facing now are far greater. We've got inflation running hot, even though official numbers try to downplay it. We've got geopolitical tensions at levels we haven't seen since the Cold War. We've got a banking system that's more fragile than most people realize, as we saw with the Silicon Valley Bank collapse and the subsequent contagion. And we've got central banks that have printed more money in the last 3 years than in the previous decade combined. All of these factors are driving demand for physical gold and silver as a safe haven, as a store of value, as insurance against systemic risk. And that demand is running headlong into a supply situation that's already tight and getting tighter. Let me give you some numbers that should make this crystal clear. In 2022, central banks bought 1,136 tons of gold. That was a record. In 2023, they bought over 1,000 tons again. These aren't small players. These are the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey. They're buying hundreds of tons each. And they're not buying paper gold. They're taking delivery of physical bars and storing them in their own vaults. At the same time, gold ETFs, which had been a major source of supply as investors sold shares, have started seeing inflows again. The largest gold ETF, GLD, saw its holdings increase by over 100 tons in the first quarter of this year alone. That's physical gold that has to be purchased and vaulted. On the supply side, gold mine production is essentially flat. We're not discovering major new deposits. The easy gold has been mined. What's left is deeper, lower grade, more expensive to extract. And with energy costs rising, the cost of production is going up, which puts a floor under the gold price. But here's what really keeps me up at night, and what should concern every gold and silver owner: the derivatives market. There are trillions of dollars in gold and silver derivatives outstanding. These are complex financial instruments that derive their value from the price of gold and silver. When the price moves sharply, these derivatives can create cascading effects through the financial system. In 2008, we saw what happens when a derivatives market blows up. Lehman Brothers collapsed because of mortgage-backed securities, which were derivatives based on real estate. The gold and silver derivatives market is smaller, but it's no less dangerous. If we see a sharp move in precious metals prices, particularly to the upside, it could trigger margin calls and forced liquidations that ripple through the entire financial system. And here's the thing. The people who are short these derivatives, the banks and institutions that have sold gold and silver they don't have, they're not prepared for a real squeeze. They've been operating under the assumption that they can always source physical metal if they need to. But what if they can't? What if the physical market is so tight that there's simply no gold or silver available at any reasonable price? That's when you get what's called a short squeeze. The shorts have to cover their positions, which means they have to buy. But if everyone's trying to buy at the same time and there's no supply, the price goes parabolic. We saw this with GameStop in 2021, but that was a stock with no intrinsic value. Imagine the same dynamic playing out in gold and silver, which are real assets with thousands of years of history as money. There's a reason why every major empire in history has eventually debased its currency. Rome did it. The Byzantine Empire did it. Weimar Germany did it. And every time, the result was the same. The currency collapsed and people fled to hard assets, primarily gold and silver. We're watching the same process unfold right now with the dollar, just in slow motion. The U.S. national debt is over $34 trillion and climbing. The interest on that debt is now over $1 trillion per year. That's more than we spend on defense. And with interest rates higher than they've been in decades, that interest burden is only going to grow. How do you service that debt? You print more money. And what happens when you print more money? The currency loses value. This is why central banks are buying gold. They see the end game. They understand that the dollar's role as the world's reserve currency is not guaranteed forever. And they're positioning themselves for a world where gold, not dollars, is the ultimate form of money. But here's what makes this moment different from every other time in history when currencies have collapsed. We're more interconnected than ever before. When Rome debased its currency, it affected the Roman Empire. When Weimar Germany hyperinflated, it affected Germany. But when the dollar loses its reserve status, it affects the entire world. Every country, every market, every asset class. The ripple effects will be unprecedented. And that brings us back to you, sitting on your gold and silver, wondering what this all means. Here's what it means. You're holding the assets that will be revalued upward when this transition happens. Not because gold and silver are going up in value, but because the currencies they're priced in are going down. Think about it this way. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Gold hasn't changed. What's changed is the value of the currency. In 1920, gold was $20 an ounce. Today it's over $2,000. Did gold become 100 times more valuable? No. The dollar became 100 times less valuable. So when I say this could change everything for gold and silver owners, I'm not talking about getting rich quick. I'm talking about preserving wealth through a monetary transition that's going to wipe out the purchasing power of paper currencies. Your gold and silver are your insurance policy, your lifeboat in a sea of devaluing fiat money. But timing matters. Right now, we're in what I call the calm before the storm. The paper markets are still functioning. You can still buy physical gold and silver, though premiums are higher than they used to be and delivery times are longer. But there's going to come a moment, and I believe it's coming soon, when that changes. When the physical market seizes up, when premiums explode, when you simply can't get metal at any price. We've seen glimpses of this. In 2020, during the pandemic panic, try finding silver rounds or bars. Dealers were sold out. Mints couldn't keep up with demand. Premiums went from $2 over spot to $8, $10, even $12 over spot. And that was just a taste. Imagine what happens when it's not just retail investors trying to buy, but institutions, sovereign wealth funds, pension funds, all trying to get physical metal at the same time. The premium won't be $10 over spot. It'll be $100, $200, maybe more. The paper price will become irrelevant because you won't be able to buy physical at the paper price. This is why, if you own gold and silver, you need to understand that you're not just holding an investment. You're holding a form of money that has survived every currency collapse, every empire's fall, every financial crisis in human history. And you're holding it at a moment when the largest currency experiment in history is coming to an end. The signs are everywhere if you know where to look. The BRICS nations expanding and discussing gold-backed trade. Central banks buying at record levels. Physical premiums staying elevated even when paper prices dip. Delivery delays getting longer. Refineries running at capacity. Mints unable to keep up with demand. These aren't random events. They're all pieces of the same puzzle, and that puzzle is showing us that we're approaching an inflection point in the gold and silver markets. A point where the paper price and the physical price diverge permanently, where price discovery shifts from the futures exchanges to the physical market, where the true value of gold and silver, measured not in dollars but in purchasing power, reveals itself. And when that happens, if you own physical gold and silver, you're going to be on the right side of the greatest wealth transfer in modern history. Not because you got lucky, but because you understood what was coming and positioned yourself accordingly. So if you own gold or silver, hold on to it. Understand what you have. It's not just metal, it's financial insurance. It's a store of value that has outlasted every paper currency ever created. And in the times ahead, that's going to matter more than most people can possibly imagine right now. The question isn't whether this transition is coming. The question is whether you'll be prepared when it does. And if you're already holding gold and silver, you're further ahead than 99% of people out there. Just make sure you understand the magnitude of what's unfolding, because this isn't just another market cycle. This is a once-in-a-lifetime monetary reset, and your gold and silver are your ticket through it.